All right, welcome to the video of a illustration of a periodic inventory system with the average cost flow assumption. By now, this is the last in a series of 6 videos, so you should know these transactions quite well. So I will assume you do. If you don't, go ahead and pause it and read through it. And let's take a look at things here. So it's periodic average cost flow assumption. There's our transactions for the month. We had a beginning inventory of 400 at 25. So that's in your inventory account. And we had those purchases and those sales during the month. You'll recall those. So at the end of the month, there's our inventory account. And there's our purchases account with each of the purchases. Please ignore. In fact, let's cover it up. There's what's in your purchases account. You have 2 purchases and you have the beginning inventory. And that is 400, 200, and 400. So once again, we have the 1,000 balls available for sale. All right. And now we come to the end of the month and we have to determine the appropriate inventory and cost of goods sold balance for the month. And so here's the table. There's our beginning inventory, 400 at 25, our January 8th purchase, our January 19th purchase. So the available for sale is 1,000. The cost of goods available for sale is 27,600. And when you divide 27,600 by the 1,000 basketballs, you get an average cost of $27.60, and that makes the adjusting journal entry quite easy. We once again zero out the purchases, zero out the inventory via the credit, and then debit the inventory account for $550 at $27.60. And the cost of goods sold is $450 at the average cost of $27.60. The big thing here was the average cost was for the entire month rather than just the average cost since the last purchase when we made a sale and we used the perpetual system. And that is the average cost using a periodic system. At the end of the month, we just calculated the average cost of all the basketballs available for sale and allocated that average cost of $27.60 to the $450 in sold and the $550 in ending inventory. And so, once again, there's the excerpt of the financial statements with the balances. And congratulations, we've now come to the end of our series of 6 videos applying inventory accounting. And this is how it works. You haven't learned, there's nothing you're going to learn in the real world that's any more sophisticated. There's just a lot more transactions in the inventory. in the purchases account, in the cost of goods sold account. But the mechanics are exactly what we just saw under the perpetual system, the periodic system, the perpetual or the periodic, using either FIFO cost flow assumption, LIFO cost flow assumption, or average cost flow assumption. All right. So I hope you've got that mastered by now. If you don't, by all means, just rework the case, work cases in your homework, and you'll have this mastered. Nice job.